Hello, and welcome to Introduction to Business Lecture Series. My name is Aziz Allaberganov, and in today's lecture, we'll discuss business ownership. The agenda for today is very simple. First, we'll talk about types of business ownerships, we'll give the definitions for it, and then advantages, disadvantages of sole proprietorships, partnerships, and LLCs. And then we'll follow it up with a discussion of liabilities, definition of liabilities, and in general, what liabilities stand for, and how they work. And then we'll also discuss and wrap the lecture up with how corporations are formed. Now let's talk about types of business ownership that exist in the world. There are many types of business ownerships, but the major ones are sole proprietorship, partnership, LLC, and corporations. Sole proprietorship basically means that the business is owned by one person, or there's a single owner of that business operation. So the person who started the business is the general owner and the manager of that small business. Partnership basically means that there are more than two people that are involved in business operations. So usually in partnerships, we have 2, 3, or 4 people that open the business and organize and manage the business operations. The next one is what we call limited liability company, or LLCs. LLCs are very similar to sole proprietorships and partnerships, but it has a very distinct difference between them, which we'll discuss in the upcoming slides. The next one is corporations. Corporations are owned by stockholders. It has a very distinct differences from the sole proprietorships and partnerships and LLCs. Now let's go ahead and discuss sole proprietorship first. Let's take a look at the advantages and disadvantages of first type of business ownership. Just like the coin has two sides, every business ownership has advantages and disadvantages. There are many advantages and disadvantages that are involved with sole proprietorships. Sole proprietorships are a very common type of business ownership that exists in the world today. It is very common in developed and developing countries. The main advantage of sole proprietorship is easy formation. In most countries, you can just fill out the application and mail the local authority to open the business, and you'll have the business operations ready in few weeks. The next main advantage of sole proprietorship is retention of control. As a single owner of the corporations, you can make decisions by yourself. You don't have to share decision making with anybody, and you can make the major decisions by yourself without any problems, without any conflicts with anybody in the organization. You have employees, you can consult with the employees to make some decisions, but generally the final decision making comes from you. Another very important main advantage of sole proprietorship is no sharing of benefits. So you can keep all the financial and non-financial benefits with you. You only have to pay salaries to your employees, but all the benefits that you receive from business operations is controlled and fully owned by you. However, just like I said before, it has the other side of the coin. So basically, it has some main disadvantages that are involved with this type of business ownership. The first main disadvantage of sole proprietorship is limited resources. Since you're the only one in this business operations, you're alone. So because of that, you will have limited resources. You have to invest your personal money into the business operations, and sometimes it might not be enough to open a big operations or expand your business operations, so on and so forth. So the many business operations that are involved with sole proprietorships have the limited resources disadvantage. And with that comes the limited skills disadvantage. Because you're only one in the business operations, you have limited skills that you have to work with. Yes, you can employ many workers, you can create jobs, but you have to look for those skills outside of yourself. So basically, as an example, you might be an excellent accountant, you might know numbers very well, you might be very good in mathematics, but because you're only good in accounting, you'll be limited to that. So you might open a very successful company, you might have very good accounting control, you might be able to do all the budgeting yourself, you might be able to do your calculations, costs and benefits by yourself. However, you will be limited in marketing, you'll be limited in HRM, and so on and so forth. So in order to get that HRM and marketing, you have to hire a specific people, specialists to work for you. So you have to look for other places to find these skills because you have only limited skills in the business operations. Last but not least, the main disadvantage of sole proprietorships is unlimited liability. Basically, you're personally liable to your business operations. We'll discuss about liability in upcoming slides in more details. Next in the line is partnerships. Partnerships are not as common as sole proprietorships, but they do exist in some forms in many countries, and we study them in Introduction to Business. Partnerships, as I said earlier, are owned by 2 or more people. Up to 10 people have ownership of the business operations. And just like sole proprietorships, partnerships also have advantages and disadvantages, or it has 2 sides. So let's start with advantages of partnerships. The main advantages of sole proprietorships are financial leverage. If you looked at sole proprietorships and we saw that financial problems are the disadvantage of sole proprietorships, this problem is solved in partnerships. Basically, if you have a partner, if you work with 2, 3, 4 people together in a business, if you open business together, you will solve the problem of finances. So if you don't have enough money to invest in the business, you can ask your partners to invest some of their personal assets or some of their accounts into the business operations, so you'll solve the problem of finances, which is also followed by skill leverage. So if you looked at the sole proprietorships and saw that you'll have limited skills and its disadvantages, this problem is also solved in partnerships. So when you open a business with somebody together as a partner, you will solve that problem of skills. So for example, you might be very good in accounting, you might be able to solve all the mathematical accounting problems or issues in the business operations, and then your partner might be good in marketing. He might be a marketing specialist, or she might be a marketing specialist. So she will take care of, or he will take care of the marketing side of the business operations, and you will take care of the accounting side of the business operations. So you don't have to hire another person to do the job for that. So more partners you have with a lot of different skills, you have that advantage in business operations. Just like sole proprietorships, partnerships also have their own limitations. The main limitation of partnerships is the logical one, which is decision making. When you have more than one person involved in decision making and ownership of the business, you might have some conflicts in terms of who's going to make what decisions, which direction we're going to follow as a business, and so on and so forth. Now, in some business partnerships, you have some kind of a contract of decision making and contract of responsibilities. But in others, you might not have any contracts, so this might lead to a conflict. So you might have a very important decisions. For example, you're trying to expand to different locations and so on, and you want to get the option A, and your partner wants to get option B, and the third partner wants to get option C, and so on and so forth. And in this situation, you might have some conflicts. Some partnerships, they resolve this conflict by voting. They decide by voting into different directions, and so on and so forth. Now, if you solve the problem of finances and skills in partnerships, it has a very limited side to it. For example, when your partners invest time and money into your business operations, they want to get some share of the benefits, which is logical. So another very important limitations of partnership is that your income or your share benefit will be lower compared to sole proprietorships. So as a partner, you have to share, just like you have to share the decision making, you have to share the benefits, both financial and non-financial benefits, with your partners when you do the operations. And then, just like sole proprietorships, partnerships also have the problem of unlimited liability. Now, what is unlimited liability, or what is liability in general? I mentioned liability multiple times in my slides previously for sole proprietorships and partnerships. Let's take a look at this diagram. The square box represents a business operation, and the circle inside is a business owner, or you are the owner of this business. So we've decided to put the circle inside the square to represent the unlimited liability situation. So the reason why the circle is inside the box is that the owner and the business are one. So they have basically the same accounts. So in this situation, the business assets and then your personal assets are almost the same. You invest money into it, and the cost that incurred in the business is also your costs, which represents the unlimited liability part. So let's imagine a customer comes to your shop, and let's say this is a coffee shop. Customer comes to your shop and orders a coffee. And the coffee is bad, the customer gets sick, and the customer goes to the hospital because of your product. The customer spends a few months in the hospital. It's a very, very bad product. And when a customer comes out, in most situations, the customer can sue the company for the defect in the product and for the health damages that was incurred by consuming your product. Now, in this situation, you're personally liable for what customer wants to get from you, or from your business. So basically, if a customer sues your company for a big sum of money, then you have to pay from your personal assets, from your own pocket, for that damage that was incurred by the business. Now, how do we solve this problem of liabilities? Well, we can take you out from the business operations and basically differentiate you from the business. We can separate you from the business, and that's what we call a limited liability. So if we take the circle out in the second situation, you have the circle outside of the business now. So we separated you from the business. Now your liabilities, which is your personal assets, are separated from the business. And as you can see in this situation, your personal assets, your personal liability, and business liability are separated. Basically, your business becomes a legal entity. So your business has its own account, and you have your own account. If we go back to the same situation, customer comes back to sue the company, but because now you're separated from the business, only the business is responsible for that bad product, not you. So the business has its own account and you have your own account. So business will be separately responsible for the damages that was incurred by the consumer when they ate or when they drank your products. Now, how can we provide the limited liability for business owners? Well, we can provide it in the form of LLCs, or limited liability company form, or business ownership. In this business ownership, basically you're still a sole proprietor or a partnership, but you purchase that a form of business ownership and you become an LLC. So if you're a sole proprietor and an LLC, you have the same advantages of the sole proprietorship and same disadvantages of sole proprietorship, but you only eliminate that unlimited liability from the sole proprietorship disadvantages. Same thing with partnership. You can be a partnership, you'll have the same advantages as a partnership, but when you become an LLC partnership, then you keep that advantages, but you eliminate the unlimited liability from your disadvantages as a partner. So that becomes your advantage. So unlimited becomes limited and becomes your advantage as an LLC. Just like other business ownerships, LLCs also have their limitations. The main limitations of LLCs are the cost associated with formation of these type of ownerships. So for example, it can be very expensive to form LLCs and so on and so forth, and it can require a lot of documentations to form one. Now, the last type of business ownership that we're going to discuss today is corporation. Corporations are a very common type of business ownership that exists in the world today. It's very famous in developed countries, and it's becoming famous in mostly developing countries as well. Corporations are very similar to LLCs in terms of liabilities. So just like LLCs, corporations provide limited liability protection for their owners. Now, besides limited liability, corporations also offer what we call the transfer of ownership. So for example, if you have a sole proprietorship or partnership, it's very difficult to transfer the ownership. For example, if you want to transfer the business to somebody else, you have to go through a lot of documentations. Sometimes you have to wait a couple of days and so on and so forth to transfer your ownership. Or sometimes if you want to close your business, if you're not interested in business operation anymore, if you want to open another business and close your current one, you have to go through, again, some documentation, so on and so forth. But in corporations, the problem is solved. So corporations, as I said before, they're owned by stockholders. So whoever buys a stock from a corporation or from somebody that belongs to a specific corporation, that person becomes the owner of the corporation. So basically, as the owner of corporations, you don't have to go through a lot of steps to transfer your ownership to another person. As long as you sell your stock successfully to somebody else, that person becomes the owner of the corporation or a company. But the next major advantage of corporations is access to funds. As corporations, you don't have the limitations such as sole proprietorships with finances. Corporations can raise money very quickly compared to partnerships and sole proprietorships. Basically, they raise funds through a lot of investments. A lot of companies and institutions are interested, and other individuals are interested to invest in corporations. So they can do that very quickly. So by issuing stocks and bonds, corporations can raise a big capital for further expansions and further projects and so on and so forth. However, just like other ownerships, corporations also have their biggest disadvantage. There are many disadvantages that are associated with corporations, but the biggest one is double taxation. How does it work? Well, first, when companies make money, they have to pay taxes. Because corporations can issue stocks and bonds, they can raise capital very quickly and have limited liability as an advantage, corporations have to pay a very big tax, and it's called corporate tax. Corporate taxes are very high, sometimes 20%, 25 to 40% in some countries. So once they pay corporate tax, then they have what we call money left after taxes. Now that money also can be taxed if they pay dividends to their stockholders. So basically, after they pay corporate tax, they have some money left to pay out for their stockholders. Why they have to pay out to the stockholders? Because the stockholders are owners of the corporation or of the company. So because they're owners, they have to get certain shares or benefits of being a stockholder for the company. So companies can do that by issuing dividends to them or money for their ownership of the corporations. Now this dividend is also taxed at different level. Now depending on how many shares you have and how much ownership you have in the corporation, you have different dividends. Now when you receive that dividends, you have to pay another tax, which is a second tax, and it's called income tax. So basically, before you receive your dividends, you have to pay taxes as if you made money. So it's like you're working and getting a salary. So you pay income taxes. Income taxes are very low compared to corporation tax. Corporate tax may be 40% and income tax can be 10 to 15%. And that's how the double taxation occurs. So corporations, they make money, they pay corporate tax, and then once they finish the corporate tax, they have to give dividends to their stockholders, and when stockholders get money, they have to pay income tax. So they're taxed twice in corporations. That is the main disadvantage of many corporations today. Now, how corporations work, or how they are formed. Let's talk about the background of formation of corporations. Corporations are usually formed by different stages. The first one is called articles. Articles of incorporation. When you write article for a corporation to form a corporation, you have to briefly describe the basic information of your company. The basic information can be the name of the corporation, a number of stocks to be issued, types of stocks to be issued, and so on and so forth. How many employees will work in the company, and so on. Now, and then after that, you have to create what we call bylaws. Bylaws are basically a bit more specific information about the corporation that you're going to form. So in the bylaws, you have to mention specific information such as who is going to be the board of directors, how they're going to be elected, how many meetings you're going to have, what kind of votings you have, and so on and so forth. Now, once the articles and bylaws are finished, all the information, the basic information and the detailed information about the corporation is filled out and put into application. It's sent to the government. Government approves it, and the corporations are formed. When the corporations are formed, it starts issuing stocks. People buy stocks, they become stockholders, and because the stockholders don't work in the corporations most of the time, they're just simple owners of the corporation, they have to have representatives in the corporation to present their case, and they're called board of directors. So stockholders vote for board of directors to represent them in the meetings. So basically, stockholders, as a stockholder, you have a voting right. And once the board of directors are elected, board of directors elect agents, and they work with agents. The agents are the main managers of the corporations, such as CEOs, CFOs. So board of directors basically monitor the actions of the top managers in the corporation to represent these stockholders' interest, and so on and so forth. That is it for business ownership today. Thank you for watching, and see you soon.